Hello, everyone, and welcome back to the podcast. I'm here with my glove mic once again, which is the only way I know of how to reduce the echo, putting the driving glove on top of my microphone. Today, we are going to be doing an update on my Amazon thesis, which you may remember a year and a bit or so ago, I wrote a thesis explaining that free cash flow was going to explode. That is exactly what has happened, and there's actually a lot of key learnings that we can take away from this case study. So let's get deep into it. In my original Amazon deep dive written in January 2023, I explained how Amazon was set up to explode its free cash flow levels and reach record highs. As you can see in the graph below, the thesis has played out correctly. But what's interesting is the mental model that led me to this conclusion, which I used to in turn advise family members to make a big purchase of Amazon stock at the $100 level. Simply put, I understood that free cash flow per share was going to hit new record levels a few years ahead because Amazon's culture remained finely tuned for that goal. And this may sound a little bit simplistic, but you're going to see in the remainder of this update, it's actually quite simple, but in practice, it's not easy. In my recent Costco deep dive, I explain how they have succeeded by executing and improving the same algorithm for decades now. They've simply focused on delivering more value to customers at a lower real price over time, and that has equated into an enormous earning power. By reading all their shareholder letters from 1998 to 2023 included, I understood that the essence of this algorithm is actually culture. Everyone at Costco lives and breathes the mission, so while we can't quite anticipate or predict what actions employees will take in order to satisfy the algorithm to deliver more value at a lower price, we can actually rely on them executing well and succeeding over time. Costco therefore serves as additional proof, as well as my successful picks to date and the ones that haven't gone so well, that validates the mental framework that I teach in my tech stock called my course. Similar to Costco, Amazon is constantly compounding the core value drivers of its business. It's, in a sense, executing an algorithm too. These value drivers are selection, convenience, and price competitiveness. The decline in free cash flow in the 2020 to 2022 period depicted in the previous graph came as a result of Amazon investing in its distribution network in order to supercharge the aforementioned pillars. And so therefore, qualitatively, Amazon was doing the right thing at that time. However, the market punished Amazon for taking this decision, with the stock price falling over 50% from the highs in 2021. Amazon therefore not only sacrificed its operating margin and free cash flow production, but also took the hit from the market. Thus, although the decline in the financials was startling at that time, I saw Amazon's investment as a sign of a strengthening culture and not one in process of degradation. In my view, this increased the odds of Amazon emerging successful once again from its latest Capex cycle. And you will wonder, what do you mean by a Capex cycle? As depicted in the graph below that you see on the screen now, in my original Amazon deep dive, I spotted many instances throughout Amazon's history of the company stepping up Capex in order to improve selection, convenience, and price. Every time this has happened in the last 2 decades, Amazon's operating margin and free cash flow levels have dwindled in the short term, only to then reach all-time highs down the line. Much like Costco, in this last round, no one could have predicted in any of these Capex increments the exact actions that Amazon employees would take in order to materialize the archetype that you can see on the screen now. But their focus on relentlessly expanding selection, convenience, and enhancing price competitiveness has gotten them to record free cash flow levels once again. The summary of the above observations and the main takeaway for me, and by extension perhaps for you, is that stock prices actually track culture over the long term. No one can predict the future, but we can bet on companies that are likely to overcome obstacles along the way and take the right decisions in order to enhance their earning power over time. When I talk about what I believe certain tech companies will evolve into years or perhaps even decades down the line, I am simply isolating dynamics that I see playing out at present and extrapolating them over the long term, based on how likely I think the company in question is likely to capitalize on them. In this manner, for example, I see Spotify evolving into an audio search engine and Palantir into a platform that connects and enables the communication and interaction between digital twins. Going back to Amazon, the other source of uncertainty at that time when I first started the company surrounding the stock was Andy Jassy stepping up as CEO and Jeff Bezos stepping down. 2 major data points convinced me that Andy was going to be, and still is in my view, a good custodian of the Amazon culture. One, his first letter to shareholders, and two, the graph that you see below on the screen now. In his letter, I was able to appreciate his in-depth understanding of Amazon's philosophy, and in turn, his management of AWS since inception proves that he is capable of translating these principles into action. Indeed, by July 2021, as you can see in the graph on the screen now, AWS was clearly Amazon's profit engine, and he was the man responsible for that. This enabled me to see that Andy Jassy stepping up did not diminish the odds of Amazon's quote-unquote Capex ghost, as I refer to it, playing out again. In the Q2 2024 earnings call, what perhaps caught my attention most is Andy Jassy's remarks about internal models that enable them to calibrate capacity with operating income. If they deploy too much capacity, this erodes operating margins and therefore free cash flow. But if they don't deploy enough capacity, then this upsets customers and over the long term erodes the company's earning power. Indeed, I had no idea that Amazon had over many years developed complex algorithmic models to help them manage this complexity and this trade-off. These models are an example of the unpredictability of the actions Amazon employees will take to execute the algorithm, again enhancing selection, convenience, and price competitiveness. And indeed, an example of how investors don't need to know every single aspect of a company, but rather how an in-depth understanding of the culture and of other core components of the business, which I analyze and I dissect in my Tech Stock Goldmine course, are enough to yield attractive returns. Here's what Andy Jassy said about the models during the Q2 2024 call.
So most companies deliver more capacity than they need. However, if you actually deliver too much capacity, the economics are pretty woeful and you don't like the returns of the operating income. And I think you can tell from having, we disclose both our revenue and our operating income in AWS. We've learned over time to manage this reasonably well. And we have built models over a long period of time that are algorithmic and sophisticated, that land the right amount of capacity. And we've done the same thing on the AI side. Now, AI is newer, and it's true that people take down clumps of capacity in AI that are different sometimes. But it's also true that it's not like a company shows up to do a training cluster asking for a few 100,000 chips, the same day. Like you have a very significant advanced signal when you have customers that want to take down a lot of capacity.
My second key takeaway from this call is that the strength of the moat over the long term tracks the frequency of the network. Let me explain. In doubling the size of its fulfillment network, Amazon also decided to regionalize it. Per Andy Jassy's remarks during the Q2 2024 call, this promises to ultimately increase the frequency of the network, or in other words, how often people shop at Amazon.
But at the same time, we found a number of other areas where we believe we can take our costs down while also improving the customer experience. One of the great things about regionalization was it not only took our cost to serve down, but it meaningfully changed the speed with which we're able to get items to customers.
As Amazon delivers a broader range of SKUs in under a day, customers come to rely on Amazon more for an increasing share of their daily needs. This naturally increases Amazon's revenue per customer, but also has the effect of strengthening the moat. By dropping prices per every increment in selection and speed, ultimately a form of convenience, Amazon makes it harder for others to compete. As the frequency of the network increases, the difficulty in competing with Amazon increases disproportionately. Q2 2024 is the first time that I hear Andy Jassy talking about this explicitly. This dynamic should accelerate the profitability of the e-commerce division by increasing ARPU, our average revenue per user, as previously mentioned, and most importantly, by enhancing the defensibility of the operation.
As we lower our cost to serve, we can add more low ASP selection that we can support economically, which coupled with our fast delivery puts Amazon in the consideration set for increasingly more shopping needs for customers.
Another thing that caught my eye is that now services begin to outpace products clearly in terms of total revenue. In the Amazon deep dive, I also pointed out that services were set to become the most important component of Amazon's income statement. Since Q1 2023, services have gone from 55.26% of total revenue to 58.39% in the last quarter, as you can see in the graph below. What's particularly interesting about this trend is Amazon is gathering data on three core components of the economy via its digital services. One, developers via AI, two, companies via its third-party services, and three, consumers via Amazon Echo. The financial rewards from them training AI models on this data and then leasing them out to the world could surpass the revenue from all its current operations in a not too distant future. Amazon is simultaneously building out a generative AI stack, which I wrote about in the past in one of my previous Amazon updates. Essentially, this stack has 3 layers. 1, to enable folks to build models. 2, another layer, allow people to manage all the complexities involved in training, deploying, and maintaining these models, and it's called Amazon Bedrock. And lastly, 1 to run Gen AI applications called Amazon Q. The most immediate result from this stack is not only more revenue on the computing side, of course, because it brings more people towards AWS, but a personal shopping assistant called Rufus. When asked about the potential of generative AI during the Q2 2024 earnings call, Andy Jassy said the following.
Generative AI especially is quite iterative, and companies have to build muscle around the best way to solve actual customer problems. But we see so much potential to change customer experiences. We see it in how our generative AI-powered shopping assistant, Rufus, is helping customers make better shopping decisions.
Now, while the above may take time to crystallize into a notable improvement at the income statement level, Amazon's revenue from advertising continues to grow fast and will likely visibly rear its head in the financials sooner. In the graph below, you can see how total advertising revenue compares to AWS revenue. Advertising revenue is thus becoming increasingly meaningful for Amazon, and this is naturally a high-margin operation. In the Q2 call, Andy Jassy explained that advertising is a key component of profitability in the North America segment, and that this is just the beginning.
For perspective, we've added over $2 billion in advertising revenue year over year and generated more than $50 billion in revenue in the trailing 12 months. Sponsored ads drive the majority of our advertising revenue today, and we see further opportunity there. Even with this growth, it's important to realize we're at the very beginning of what's possible in our video advertising. With ads in Prime Video, the exciting opportunity for brands is the ability to directly connect advertising that's traditionally been focused on driving awareness, as is the case for TV, to a business outcome like product sales or subscription signups.
That last comment from Andy Jassy points to what I would term performance branding. Traditionally, marketing dollars have either gone to branding or performance marketing, the former consisting in creating brand awareness and the latter consisting in optimizing marketing dollars for a specific goal, such as customer conversions and so forth. Amazon's opportunity now is in combining these two marketing types to ultimately offer a value proposal that is not available anywhere else and that can radically increase the efficiency in marketing spend for its third-party customers. Going forward, much of Amazon's incremental capex will likely be directed towards AI. Much like with other technological trends, there is no guarantee that the enthusiasm that we currently see now will last forever. However, the North Star for Amazon investors going forward should be whether Amazon is compounding or is enhancing its core value drivers or not, and whether the company remains faithful to its principles. This time around, this simple approach has worked, with the stock up 184.7% since I indirectly purchased Amazon. This relatively simple qualitative analysis is very much in line with my analysis of other excellent businesses, and this includes retroactive analysis, such as Netflix, Costco, and Amazon in this case and so forth, and forward-looking analysis, such as AMD and Tesla, which I've been a shareholder for AMD for over a decade now, and in Tesla for just over 8 years now, and Palantir and Spotify, which, as many of you know, are up big time since I bought them, using the same framework to perform the analysis. As I was saying, this framework also seems to explain why investors capitulated on Netflix stock in late 2023, only to then see it bounce back 288% at present. You can read the update on my Netflix deep dive clicking on the link in the show's footnotes. I look forward to continue studying all of these companies in order to continue iterating on my framework and make it better over time. I hope that this analysis has served you well and that you learned something. And if you did enjoy it, can I please ask you one favor? Can you please share this with one friend whom you think will enjoy it? These deep dives are for free, and so the only way this grows is with your help. Thank you very much in advance, and until next time, take care.